All right, so I want to do case six, which is really just an example of applying OCI ideas to an income statement to develop how OCI ties into the accumulated other comprehensive income, while net income ties into retained earnings. So Joywave has the following information completing its 20x6 income statement. It began the year with a $1,756,000 balance in its retained earnings account and ended the year with a $1,824,000 balance after all closing entries had been made. I specify that. I wouldn't necessarily need to specify that because with retained earnings, its ending balance, by definition, has had net income close to it, dividends closed. So it started with $1,756,000 and it's ending the year with $1,824,000. This is all we get from that first bullet point of information. I can draw out a T account to track retained earnings. For its AOCI account, accumulated other comprehensive income, it has a $50,000 debit balance. And remember, like I mentioned, both of these can have debit or credit balances. If retained earnings has a consistent debit balance over time, this is a company in trouble because that it indicates that if it has a debit balance, we've been closing a lot of net losses into retained earnings. So companies can have debit balances and retained earnings, but it doesn't tend to be persistent. If it is, they die, they liquidate and go out of business. AOCI is one that can and frequently does have debit balances because remember, we're just looking at that one small portion of the company. Um, Basically, that tiny section below retained earn, below net income, where we put those four effects. And remember that those are only the result of four effects. They aren't the entirety of um, they don't represent the entirety of the company. And so it is very likely that, for example, this will be positive and this small section will be negative, and comprehensive income, who knows if it'll be positive or negative? It just depends how positive net income was and how negative the OCI was. But remember, this is all AOCI tracks. It does not track comprehensive income. We do not close comprehensive income into AOCI. We only close other comprehensive income. And the reason is comprehensive income includes net income. And so if I close comprehensive income in here, we'd be closing net income to retained earnings here, and then closing it again when we close comprehensive income. So this just tells me in this problem, $50,000 debit, that in balance, when I consider all the OCI gains and losses since the beginning of this company's existence, it has an overall negative loss balance of 50,000 when I add all those together. And then it says the company has not yet calculated the ending balance. So we don't know if it's a debit or a credit, but we'll see. The company has an effective tax rate of 40%, declared and paid $250,000 of dividends during the year. If they declared $250,000 of dividends, that would be a debit to retained earnings when I closed those dividends with a credit. We saw that already. Just remember, this would be a result of closing dividends. Then we have two additional transactions that are noted. We have a $35,000 unrealized gain. That's pre-tax. It arose from available for sale securities owned by the company. So, like I said, it's unrealized. That means we haven't actually ordered the sale of those yet. It just means that maybe I bought them at 100,000. So my investment, I spent 100,000, but now they're at $135,000 value. So if I chose to sell them, I could get $35,000 profit. I have not chosen to sell them yet. It's unrealized. Because it's unrealized and AFS, that means it's an OCI item. And then it says, due to the depreciation of the US dollar, Joywave uh, recorded a foreign translation gain of $50,000 in its foreign investments. So as the dollar weakens against a foreign currency, the value of that foreign currency is more than it was against the dollar prior to the weakening. So this results in a gain. Also, one of those OCI gains we have. So what does it want from us? It wants us to provide the ending balance of the accumulated other comprehensive income. So we need to figure out what that is. And then we need to figure out the amount of comprehensive income. So it's important that you understand the difference between that AOCI balance and this, which is just asking me for CI. So my two OCIs, 35,000 and 50,000, they're both gains. Gain here and gain there. They're both pre-tax. So if I had to figure out comprehensive income, remember comprehensive income comes from adding or subtracting my OCI, but starting at net income. So I want my balance here and I want comprehensive income. Those are my goals. Well, here I can go ahead and insert these amounts into the AOCI because remember, these are closed. These are OCI items closed directly into AOCI, except these are pre-tax. And I need to net tax from them. All right. So if I net tax from these two pieces, I have a $35,000 gain and a $50,000 gain, 40% tax. This would be the result of applying 40% to each of these amounts. These would be their tax effects. To get the net of tax amount, subtract. This is my net of tax and net of tax. Oops, yeah. 21 and 30,000. These are both gains. When they get closed into AOCI, they would be closed in as credits. Think about gains being credits and ultimately crediting my AOCI account. Together, then, they reverse the debit credit balance. It goes from a debit balance of 50 up to a credit balance of 1,000. All right, that's the AOCI ending balance. This piece is still a little in doubt because yeah, we have the OCI amounts. The OCI amounts are just the 21 and the 30. Because remember, those are the individual gains and losses, net of tax. This is the equity account that accumulates those over time. We just added these new ones during the period to the accumulation of all the old ones that came before and rolled it forward as a new balance. But this comprehensive income, in order to figure it out, we're going to need what is my net income for the period. The only way we're going to find net income for the period is to think about our retained earnings balance. Because if I started at this balance and then paid $250,000 of dividends, if I had no income, it wouldn't equal this amount here. So I must have had some amount of income in order to obtain this ending balance after closing entries are made. And so if I solve for that amount of net income, That means I get that. Net income should be $318,000 because then the beginning retained earnings balance, less those dividends plus this income, would give me the appropriate ending balance. So that is my amount of net income. And then I adjust for these two OCI. Remember, these are gains. They would add to net income, net of tax, which gives me total comprehensive income of $369,000. So this is just a sort of exercise in figuring out, well, first understanding what goes into retained earnings, um, understanding the difference between an OCI effect, right, and AOCI and comprehensive income. In terms of how this would be reported on a balance sheet, I wanted to kind of address that just as an alternate presentation of AOCI and all of this good stuff. What we would see, for example, of course, we have all our assets and our liabilities. We don't have to go through all of them, but they're there. We come all the way down to equity, and then we have like common stock and APIC and maybe some preferred stock. But then we have our retained earnings and our AOCI. And this is at, let's say, 1231 x2. I'm sorry, this is the, I'll stick with the date in the problem. It's actually the X6 income statement. So this is 1231 X6. And then the prior balance was X5. So I don't give you information about any of this except for these two. The retained earnings balance, the beginning would have been the imbalance of the prior year. And now we have a new ending balance after closing entries in the year 20x6, right? For AOCI, it started at a debit balance of 50. Debit balances for AOCI reduce overall shareholders' equity. It then came to a credit balance of 1,000. And that's positive because now it's on a credit balance side. And that's wanted to make sure that was understood. You can interpret a lot from this. For example, if I gave you this format and you see that it went from negative 50 up to 1,000, that means that there must have been 100, I'm sorry, not 100, $51,000 of OCI gain overall to make that transition. And the way, again, just kind of think of this balance sheet as giving you the balances to an account. This says negative 50, so that would be 50. This says 1, so it would end at 1 since we're going from the prior calendar year to the current. This would be beginning, this is the end, beginning, end. And the overall adjustment we'd have to make would be 51,000 in order to get there. That's how this 51,000 OCI gain, how I calculated it. Okay. So just a few thoughts about that. And again, trying to harness that difference. Another way to think of OCI, it is the change in my AOCI balance for a particular period. Right? And then I apply that change, which is 51,000, to net income for the period to figure out what comprehensive income should be. There's another case just like this, case 7. I advise you to give it a go just to make sure you got everything kind of working. Definitely know how to update the balances of these accounts given information from an income statement.